Hello and welcome to Radio Waves. I'm your host, Kris Poliquin, and this is a production of Red Apples Media. We're broadcasting out of 790 AM Real Country in Leesburg, Florida. And if you're watching us on television, you're doing so on LSTV, Comcast Channel 13, Spectrum 498, and CenturyLink Prism Channel 83. So today we'll be making waves with Jon Woods, who is president and CEO of JW Mortgage. And the intention is to illuminate us all on some of the pitfalls and some of the hazards that are associated with a mortgage nowadays. So, Jon, thanks for coming on to the show.
Thanks for having me, Kris. I look forward to be here.
All right. You should. It's a great show. All right, so tell us a little bit about you and why you wanted to start JW Mortgage.
So, Kris, I've been in the mortgage business for about 25 years. So I know the way I look. I started when I was 12, but that's not true. That's not true. But I have been in the business for 25 years, and I worked mostly for mortgage lenders. And what I saw happening was people were being taken advantage of. People were paying interest rates that were higher than they should be paying. They were paying more fees than they should be paying. And it really got to me. And so I started JW Mortgage Group in an effort to right some of the wrongs that I saw over my career in mortgage lending. Today, my goal is all about education. I want to make sure people understand what they're doing, what they're getting into, and what could possibly happen, could possibly go wrong through the mortgage process.
Because it is very complicated. It's not just going to the bank and saying, can I borrow $6,000 for a car? There's a lot of steps, a lot of oversight. It can be overwhelming.
A lot of the oversight we had today, Kris, I think it was necessary. We had virtually no oversight prior to the crash in 2005, 6, 7. And the problem was a lot of mortgage people were taking advantage of customers. So today we have more oversight than we ever have. As a matter of fact, I will tell you probably have more paperwork today and more time involved in a $100,000 home purchase than you have in a $100,000 car purchase. You can go that quicker with a car but not with a home just because of the oversight.
Oh, and I get it. And again, because of the crash, necessary.
That's right.
A necessary evil.
That's right.
So, Jon, what's the difference between a mortgage broker and a bank?
Okay, so I'm a mortgage broker. JW Mortgage is a mortgage broker. I have the ability to place a loan with any number of different lenders. So if you go to a bank to get a loan, the bank will lend you their own funds. If you go to an independent mortgage bank, they'll lend you their own funds as well. But a mortgage broker, I have the ability to go to different lenders to find different loan programs. For an example, if you came to me as a lender and you needed a loan that you couldn't document all of your income because you're self-employed, you have a lot of write-offs, tax write-offs to get tax benefits, I wouldn't be able to qualify you for that mortgage if I'm a lender. But if I'm a broker, I have access to multiple lenders who do have those type of programs, and I can help you get a loan.
Oh, okay. So, I don't want to say a shopper, but you have the ability to shop around for the customer.
Think of it like an internet search engine for hotels, except for mortgages.
Okay. And another major part of this process, if we can speak to it, are credit scores.
Yes.
We're inundated by commercial after commercial after commercial on the importance of credit scores. Everybody understands that it's important because banks look at it and lenders look at it. Can you enlighten us a little bit on what goes into a credit score and why it's so important?
Well, you know, Kris, there are actually 3 credit repositories in the United States. There's TransUnion, there's Equifax, and there's Experian. So those 3 credit repositories make up all of the credit data for you, me, and everybody else in the country. Those 3 credit repositories then will report whether you've been late with making your payments are made on time. Depending on the lender or the credit provider, they may report to one of those or to all 3 of those or 2 of those. So it's really up to the credit provider how many of those sources they report to. When you come to somebody like me to get a mortgage, I'll pull a mortgage credit report on you, and it will pull information from all 3 repositories all across the country, wherever you've had credit in your past. So we can tell, how do you pay your bills?
Right. And that's what they're looking for, is how reliable of a borrower you are.
Exactly right, Kris. So the point is, are you a good risk or a bad risk? So the higher the credit score, the better credit risk you are. The lower your credit score, then the higher credit risk, the worse risk you are as far as a borrowing goes. So what we look for is credit usage. So if you've got a credit card that has a $10,000 available spending limit on it, and you owe $9,500 against that spending limit, that's pretty much maxed out. You probably can't borrow more on that.
Sure.
That will affect your credit score in a negative way. It will lower your credit score. By the same token, if you have the same $10,000 credit card and you only owe $5,000 on it, then you have the availability of 50% more you can borrow against that card. That's a good thing. That means that your credit score will actually go up.
Okay. But so then the lower is always better. Let's say you have that $10,000 credit card and I have $5 on it. That's got to make me look like a stellar consumer.
Not necessarily. So the credit bureaus also believe that people who don't use credit are maybe not the greatest credit risk. So if you have a $5 balance on a $10,000 card, you may not be as seen as a good a credit risk as somebody who has a $3,000 balance. Good rule of thumb, about 30% of utilization will give you the best bang for your buck on your credit score.
Really?
Yes.
Right.
Now recognize we're talking about credit scores here.
Correct.
Personally, I'm all for, even though I'm in the mortgage business, get out of debt as quick as you can. Don't be in debt.
I agree.
I will preach that to everybody. But I want you to understand what impacts your score and what makes for a better score versus a worse score.
Okay. And these scores, these repositories,
Yes.
are they all the same? Or do they look at different pieces of an individual's financial history and come up with their own system?
They all have their own system and how they generate scores. So that's one of the good things about having 3 different repositories is if you only had one, everybody would have the same calculations, and maybe this person puts a heavier weight on car notes, and this person puts a heavier weight on home loans, and this person puts a heavier weight on revolving credit card debt. When you combine the 3 together for a mortgage, for example, we take the middle of 3 scores, and that's your representative score, or the lower if you only have 2 scores reporting. So that gives us the benefit of having different, even though they all have different ways of calculating their scores, we don't have to get into the detail of how they do it.
Okay, so you can have 3 unique scores.
Yes.
From each of these.
That's right. And
So how does okay, I got to ask. So then why do we not go and look at all 3 of these all the time?
It depends on what you're buying. So for an example, let's say you're going to get a $6,000 note to buy a car, to buy a used vehicle. The risk of non-payment on a $6,000 note for a used vehicle is much different than a risk on a home you're going to put your wife and kids in for the next 30 years.
Okay.
So someone who is lending you money to buy a car, they may only pull one score, one repository, because it's not as significant of a long-term risk to them as it is for if you were buying a home for your family.
Okay, so why is that system in place? And I guess what I'm asking is, I assumed that all 3 always got the same 3 information, right? So Equifax has the same information on you that the other 2 do as well. But it doesn't sound like that's necessarily the case.
No, they do have the same information. It's just how they calculate their particular score can
Okay.
be different from bureau to bureau, from repository to repository. So Equifax, for example, may put a heavier weight on long-term installment debt. So that may drive their score more than Experian may put a higher weight on revolving credit card debt. So
Okay.
that's why you're going to have multiple different scores. Let me interject one thing more if I can.
Yes.
There's a lot of news, a lot of television commercials, and a lot of information about credit scores. And there are credit companies that will tell you this is how you can get your score. Those scores are good. Those scores give you an idea of where you might land in the good versus bad credit mix, but that's not a mortgage credit score. I think it's important for people to understand that those people have a completely different vision and view and use for credit scores and credit repositories. So they may take, the same information from Equifax, Experian, TransUnion, but those scores could be completely different from the scores you'll get from somebody like me pulling a score for you for a mortgage.
Okay. So all 3 repositories
Yep.
have different systems. They all have your information, which is why banks or lenders have to look at all 3.
That's right.
That just boggles my mind. Why don't we just have one? Why don't we just have one?
Same reason we have 12 car dealerships over here on 441 in Leesburg.
Okay, fair enough. Fair enough. So, because this is such a important part of the lending process. If someone were to have poor credit, are there any recommendations where they can increase their credit score?
Absolutely. The first thing I would say is don't try and go it alone. Don't think that you're on your own in this. I found people fall into one or two categories. Generally, people who think that they're really bad credit risks, they're not usually as bad as they think they are. And people who think that they're excellent and the best in the world usually aren't as good as they think they are either. Just the way life works.
Right.
But if you think that you've had some issues, you've had some collections, you've had some issues on your credit, don't try and go it alone. Go to see a professional. Talk to somebody who has the ability to pull your credit, and they can talk to you specifically about this is where you need help. This is where you need some time. Because sometimes it just takes time, Chris. If you've had a bankruptcy in your past, there may be no way you can't pay your way out of a bankruptcy proceeding.
Right. You have to wait the years.
That's right. But if part of your problem is overutilization of debt, let's say you've got 98% utilization of all of your credit card debt, to pay that down and make a concerted effort to pay that down over time will actually be a good thing for your score.
Gotcha. You can correct bad credit.
Yes, you can.
Okay. May not be easy, and it may take some time, right? But, okay, so we need to take a quick break. But before we do, if someone wanted to get more information, where can they get that information, John?
Go to my website. It's www.jwmortgagegroup.com. And we've got a lot of information on there about different loan programs that are available. I'm sure we'll talk a little bit about that, about what you can do. We've got some information coming out of the new book, an educational book to tell people how to make things better, how to navigate the real estate financing process.
Okay, awesome. Well, I look forward to it. We'll be right back. Hello, and welcome back to Radio Waves. Again, I'm your host, Kris Poliquin, and this is a production of Red Apples Media. Today, we're speaking with Jon Woods from JW Mortgage Group about mortgages and, the pitfalls that may or may not be associated with them. So before the break, we were really keying in on credit scores, why they're important for the lending process. Let's get a little bit into the loans.
Okay.
What kind of loans are there?
You're right. So probably the most basic loan is a vanilla 30-year fixed rate conventional loan. It could be an FHA or VA loan, but let's talk about just a conventional 30-year fixed rate. It's secure, it's safe. I call it bread and butter of the loan. So you've got the fixed payment. You know what your payment's going to be every month for the next 30 years. So you don't have to worry about rates going up, rates going down. You know, you can budget.
Okay.
So that's the first one. We also have adjustable rate mortgages, which do tend to adjust. Typically, that's every 1 year, 3 years, 5 years, depending on the type of adjustable rate loan you take. Those are a little bit more flexible. So if rates go down, then your interest rate would go down. And by the same token, if rates go up, your interest rates go up. So they're a little more risky for you personally, depending on how you're going to budget. So conventional loans are one form of loans that we offer. We have FHA loans also. It's backed by the Federal Housing Administration. They require a little lower down payment, a little more flexible underwriting guidelines so you can qualify a little easier for an FHA type loan. There are VA loans that are available for veterans and members of our armed forces and their spouses. So those typically require no down payment. So a VA loan is great for our veterans. We also have a USDA loan, the United States Department of Agriculture. Rural housing is another name for that type of loan. Generally a 100% financing loan, depending on where the property is located. So much of our listening area will fall into this USDA eligible type property.
Okay.
So that's something to consider as you look for loans.
Okay. So you're listing all of these types of loans. How do you know? What do you recommend someone to find the right loan for them? Because like the ARMs, they have great purposes for the right person. And each loan is like that.
This is something we found through the crash, Chris. I can tell you that we had a lot of different loan programs, a lot more than we do today. Not every loan is right for every person. We had some really good programs that were right for a specific type of person, but they were being sold to the wrong people. I think today you have to be an informed consumer, and that's one of my biggest soapboxes is I want to make sure people are informed. I'm all about education. So the way you would know, talk to an expert, talk to a professional in the mortgage space, whether that's a mortgage broker like I am, to your local bank, because they also do mortgage lending. If you know independent mortgage lenders, talk to them. Just make sure you get the information. And there's so much information on the internet today, you just can't help but you can Google search whatever you want.
Oh, sure. And you get inundated by mail. You want to refinance here. You want a new home. And that can be overwhelming as well because there's so many options. And I've had personal friends that have gone the wrong route. Oh, I'm just going to do this. Okay, well, if it works for you, and they're like, oh, well, I should have done this.
We had a program available before the crash called an option arm. And basically you could choose, you as the borrower could choose each month how much you wanted to make on your mortgage. So you could make a payment that was amortizing your loan in 30 years. We could make a payment that amortized your loan in 15 years, which would be a much higher payment. You could make an interest-only payment, which would be lower than the 30-year amortization payment. Or you could make a minimum monthly payment, which wouldn't amortize at all, actually would show negative amortization and build the amount you owe on your house over time. It's dangerous.
To me, the key is, if you don't know, it's easy to get help. Right?
Absolutely.
It's easy to get the information. This is a big purchase, possibly the biggest you'll do. Take the time and do it right.
That's right. That's right. Don't go on your own. Don't feel like you're on your own doing this. I know that a lot of people like to do their own research. I don't want to be sold either. I don't want to call somebody and have them sell me on something that's better for them than it is for me.
Right.
So do your own research, be an informed consumer, but then go get help. Talk to the professionals. Make your own decisions. It's like hiring an attorney. I have great use for attorneys. Attorneys are great people, and I have a lot of friends who are attorneys. But at the end of the day, they work for me.
Right.
Same thing with your mortgage person.
Okay, so now that we know, let's say buying a home, and now you know you're going to get some help and find the right mortgage for you. Can you walk us through the mortgage process? Because it's not a call someone on the phone and say, yep, you're approved. You get the keys in 2 days. And there are some things that can actually slow that process down.
That's true. That's true. So one of the, in my new book called Knowledge is Power, Navigating the Real Estate Financing Process, I talk about some of the pitfalls, some of the things that could go wrong through the mortgage process, some things I've seen in my 25 years in the business. And just for an example, let's say you're looking at buying a new home, and it's a brand new constructed home. You're moving out of a place that you've either been renting or living in for several years, and you just can't imagine putting that old sofa in this brand new house. The old sofa is grandmother's old plaid, whatever it was. And it won't look good in the new house. I would caution you that if you're in the middle of the process of getting a mortgage, before you go buy any large ticket items, even furniture, but especially things like cars, I know that can come up as well. And things break down. Don't get me wrong. And that won't necessarily derail your whole mortgage process, but it may take your mortgage company a minute to stop, take a second look at what you've done, take a second look at how do you still qualify for the mortgage you're trying to get.
Good Lord. Again, things that we assume, but once you're in that process, you don't want to change a job.
Let's talk about that.
You don't want to, please.
Let's talk about that. So let's say you're in the middle of a mortgage process and you think everything is going great with your employer. You've been there for I had a friend I talked to today. She's been in her job for the last 5 years, and they told her this week, you're done. That happens.
Of course.
Life happens. But if you're at a point where you're just fed up and you've had all you can take and you can't take it anymore, I would encourage you, if you're in the middle of qualifying for a mortgage, just hold out. Just take a deep breath. Just get through the mortgage process first before you begin to find your next way in life.
Right. Because there's so many extra things that are out of your control. That's one that you can.
That's right.
Right. I'm not recommending anybody stay somewhere that they're unsafe or anything like that.
No.
But, through this process, you'll have how many inspections? And each one of those can complicate.
That's right. That's right. You'll typically, if you're buying a home, you're going to want to have a home inspector go and take a look at the home. This is not something generally that's required by the mortgage folks, but it's something you as a purchaser will want to be taken care of. In addition to that, the mortgage company is going to require an independent appraisal of your property. So that appraiser is going to go out and look at comparable type homes that have sold in the last 6 months, say, that are near where your house is located, And they're similar to what your house looks like. It's a 3-bedroom, 2-bath. It has a pool. It doesn't have a pool. It's in a subdivision. It's on a lake. It's on a golf course. The appraiser is then going to give an independent third-party estimate of value of your home, and that's what the mortgage company is going to use to see, do we have enough equity in this house, right? So those are some inspections, and I've seen those come back not so good. And that's something you can't control as a buyer. That's something the mortgage company can't control, but it happens. And those are some things that could come up through the mortgage process that could tend to derail your loan.
Now, when you say derail, could they dequalify you for a certain amount?
It could.
I mean, how important are appraisals based on the history of those homes and the current pricing, so to speak?
Critical. So let's use an example. Let's say you're buying a home for $200,000. And let's say you send an appraiser, your mortgage company sends an appraiser out to give you value. And the homes around where your house is sold, they've only sold for about $150,000. So what that means is you paid a little bit more than what the going rate is for your type of house in that neighborhood. Does that sound right?
Yes.
Okay. So if the value comes in at $150,000 and you've mortgaged based on $200,000, if you still want to buy that house, you're likely going to have to cough up another $50,000 that a lot of people don't have laying around.
Wow.
So, and again, depending on how much you were talking about putting down to begin with, if you have a significant amount of down payment, it may not be an issue for you qualifying for the loan. But if you had a very small down payment, it could blow the loan altogether.
Because the bank is looking at the value of the home, and
That's
they
right.
only know that value based on the appraisal.
That's right. That's right. And we talked earlier about oversight. We talked about government oversight, and I'm not big on government oversight, but I think we needed more than we had. And I think today we're in much better shape. We're a much more regulated environment today than we were 5 years ago, 10 years ago, because the appraisers can't even talk to the lenders. They can't even talk to anybody associated with doing a loan. So I don't have the ability to talk directly to an appraiser anymore today. I've got to go through an independent third party to order that appraisal report.
Again, illustrating the importance of a fair and accurate, the best you can.
That's right.
Because I know there's some people that go, no, I want this house. No, I want this house. And this house is only worth $150,000. Well, not today.
That's right. That's right. That's right.
Wow. Okay. So then let me ask you this. So part of the mortgage process, what do the lenders look for? We know that they're going to look at your credit score. That's not, just because you have a good credit score does not necessarily mean that you're going to be approved for the home.
That's right. It's not an automatic. There's a multitude of things that we look at. So you can look at your assets. So do you have a sufficient amount of down payment to buy the home that you want to buy? Do you have assets set aside that if something were to happen to you personally, your car breaks down, your heating, your HVAC work breaks down, you've got money set aside to be able to do that. They call that reserves. Something happens to you on your job, you get sick, your family members get sick, do you have money to carry you through until you get back on your feet? They look at that. We look at your credit history, we look at the amount of the assets you have, and we look at your employment. What's your employment history like? Are you self-employed? Have you been self-employed or just launched out on a new venture yourself and you've only been in business for the last 3 months and you just think it's a great idea to get into this, I don't know, liquid sunshine sales, whatever you want to call it.
Right.
So they like to see a history, so a work history generally of 2 years. So if you're going to be self-employed especially, they want to make sure that you have an ability to earn a living on a go-forward basis and continue to pay your bills.
Just a wealth of information, John, and there's so much. If someone wanted to speak with you
Yes.
or just get some more information to make some of these decisions, where can they get that information?
You can go to our website. It's www.jwmortgagegroup.com, or they can call our office. It's 407-660-6689. Again, jwmortgagegroup.com or 407-660-6689.
Okay. Let me ask you something else.
Sure.
What kind of market are we in right now? Because there's people who rates are always changing. Last year, someone may have gotten a great rate. Next year, they may not. What's the market look like now?
Well, I will tell you that I've been doing this a long time. I mentioned early on we've been doing it for 25 years. And when I can remember making applications back in the early 90s, and telling people that anything below an interest rate of 8% is a great rate. Lock in your rate and do it. Today, we've become accustomed to seeing rates in the 3s and 4s.
Yeah.
I will tell you, if you've seen the market over the last week, you've seen a lot of turmoil in the stock market. The bond market has experienced a lot of turmoil. Rates have begun to go up. So even if you have a friend who bought a home and they got a mortgage even 2 months ago, likely your interest rates today are going to be higher than they were 2 months ago. Rates are going up a bit, and I don't think it's a bad thing. The Fed, the Treasury has raised interest rates a bit, and I don't think it's a bad thing. But I think we all going to have to define the new norm now as maybe not 3s and 4s. Maybe we're into 5 territory.
All right. Well, Jon, that's all the time we have for today. I want to thank you again so much for coming on and sharing this information with our audience. I really appreciate it.
Thank you, Kris. I appreciate it. Enjoyed being here.
Good. All right. This has been Radio Waves. I'm your host, Kris Poliquin. We'll see you next time.